Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, investors waiting on the Fed decision coming on Wednesday. The central bank widely expected to lower interest rates by 0.25%, but President Trump saying on Sunday he expects a big cut. This all coming as Wall Street debates whether the Fed has been late to cut and the political backlash from the White House as it still seeks to oust Fed Governor Lisa Cook. And remember, the Senate is set to vote today on the administration's nominee to fill the open Fed seat, Stephen Miron. U.S. stock futures kicking off the week modestly higher given that backdrop. Plus, Elon Musk's big bet on Tesla. The CEO revealing he bought $1 billion worth of shares in the EV automaker on Friday. It's his first purchase of stock on the open market since 2020. The stock is reacting by rising here this morning, and that move is helping lift the Nasdaq ahead of the opening bell. Plus, trade tensions with China are in focus. Treasury Secretary Bessent and Chinese trade negotiators are holding a second day of trade talks in Spain on Monday. Reports say these conversations centered on TikTok, tariffs, and the economy. President Trump just posting that the meetings have gone well and suggested a deal on TikTok could be done. He'll also be speaking with Chinese President Xi Jinping on Friday. But the talks do come as China escalated its campaign against Nvidia. A market regulator is saying the chip giant violated an anti-monopoly law. It's unclear whether Nvidia will face any punishment, but Beijing said there would be more investigations, and Nvidia shares are lower on the news. Let's get a check in on stock futures here this morning. Broadly higher, despite some of that push and pull, for example, from Nvidia and Tesla. You see NASDAQ futures indicating a gain of about 0.25% at the open. Dow futures, similar magnitude. The S&P showing a gain of about 0.33%. Let's dig into our top stories of the day. China opening an investigation into Nvidia after an initial probe found the company's acquisition of a smaller chip designer may have violated anti-monopoly rules. Markets are muted as trade talks between the U.S. and China entered their second day in Madrid, and the Fed's policy meeting to get underway tomorrow, with investors expecting a cut on Wednesday. Joining me now, Yahoo Finance reporters Ali Canal, Dan Howley, and Jennifer Schonberger. Dan, I'm going to start with you and the breaking headlines out this morning on Nvidia in particular. This just one more headline showing that Nvidia here is sort of a pawn in these negotiations between the U.S. and China.
Yeah, Julie, basically the market regulator in China had said that Nvidia has violated some, or I guess is suspected of violating some anti-monopoly laws with regards to Mellanox, the acquisition that it made years ago in 2020. And so they don't really specify how they violated the laws exactly in the release or what kind of punishment, as you said earlier, Nvidia could face, if any at all. But, this is all coming as, there was this back and forth between the U.S. and China when it comes to Nvidia chips. President Trump had originally banned the chip sale of the sale of the H20 chips there, then kind of flipped in July, said you can go ahead and sell them as long as you give us a 15% cut. He added that later. And China's just been kind of going back and forth between them, saying, okay, well, telling companies to potentially not use it because of some security issue that they said exists, but Nvidia has strongly denied, or that companies should favor local players in the Chinese space. And so it seems to be, as you said, that this is just the kind of back and forth tit for tat between U.S. companies or a U.S. company between the U.S. and China. And so, trade negotiations ongoing right now. There's the TikTok talk. We think it's TikTok. President Trump had said an app popular with young people is reached a deal. They reached a deal on it. So, I mean, at this point, it really does seem as though in China, at least, Nvidia can't catch a break.
It can't catch a break, but just to put things in perspective, I mean, the stock is up almost 50% over the past year, Dan. So it looks like investors, while they're paying attention to these headlines, it hasn't, maybe it's held back Nvidia to some extent, but it has not prevented it from rallying as it sees demand elsewhere. For
sure, yeah. I mean, the talk is obviously always around China and the possibility of having the company be able to sell there, but it's not a massive part of their business. It's a large, revenue chunk, but it's not the largest by far. The U.S. is still far bigger. It's the biggest region for Nvidia sales, and they're leaning on other types of sales. Whether right now it's still the big cloud players making up about 50% of overall revenue, but they also continue to push the idea of sovereign AI, where countries build out their own AI, so they're not dependent on other countries. We've seen that in Europe and the Middle East. So they have these different levers that they're working to pull, and it doesn't necessarily mean that China is the end all be all. In fact, when we saw them say that they weren't going to report any China revenue in the prior quarter, the stock still went up because as analysts were seeing it, they figured, well, and this is before the chips were allowed to be sold again. They figured, look, that question's now out of the window. We don't have to worry about that anymore. We can just think about what regular revenue looks like for them. So it's very much been, you're right, this kind of hand-wringing over whether or not they're able to sell into China. But then when they weren't able to sell into China, everyone's okay with it. So I do think it's very much can they at least get an opportunity? And that's what I think a lot of shareholders are wondering. Mm-hmm. But that doesn't necessarily mean people are going to start, abandoning the stock just because China's not an option. Again, the U.S. is still its largest market.
Right, by a long shot. So let's talk about some of the other things that Dan alluded to, this maybe some kind of deal on TikTok. Ali, you've been looking through the commentary here and watching the market action in reaction to or maybe in anticipation of some kind of China deal.
Yeah, and the U.S. and China, they're back at the negotiating table. They've been talking a lot, but we haven't seen a very significant deal here. Now, maybe there is something to come on TikTok like the president alluded to, but really this comes against the backdrop of a lot of friction between the two companies. Dan was just laying out that case that Beijing is making against Nvidia, violating that antitrust law. You also had Beijing earlier today accusing Washington of, quote, unilateral bullying for pressing G7 and NATO allies to impose secondary tariffs on China due to the purchase of Russian oil. And markets, like you said, have mostly shrugged off a lot of these headlines, have shrugged off the fact that we still don't have a sizable deal between China and the U.S. China, one of our top trading partners there. And that's because if you look across Wall Street commentary, the focus has been on earnings. We saw significant earnings growth in the second quarter. We saw a lot of companies raise their guidance for the rest of the year. You have AI as a tailwind. You can look to last week when Oracle shares exploded due to really the benefits that they're seeing from AI and the aggressive spending from companies like OpenAI, for example, which is the parent company of ChatGPT. And then you also have the expected Fed rate cuts. The market's pricing in a 25 basis point cut later this week. So that's all fueling a lot of this optimism. We have Wall Street strategists chasing their price targets higher as we continue to see stocks at record highs here. Now, that doesn't mean the trade headlines that falls to the wayside. That's still heavily in the background. There was an interesting note from Citi that said that the U.S. effective tariff rate is only about 9%. There was a theoretical rate floating out there from the Yale Budget Lab, for example, that we were closer to 18%. Now, the reason for that, according to Citi, stems from a few possible factors. There are those tariff carve-outs. There's transshipment. So companies are starting to look at other lower tariff countries to try and avoid some of those higher levies. You also have stockpiling and some of those squeezed profit margins. Now, if carve-outs are the main factor there, the U.S. may be seeking a softer trade war. If it's those transshipments, then we could see more targeted tariffs follow. So either way, these talks between Beijing and the U.S., they may be pivotal in determining whether some of these tariff truces can hold at this point, or if we could see further escalation down the line. And we know from strategists and economists that the back half of the year, that was always where we were going to see companies and consumers be a little more squeezed.
And of course, you mentioned the odds making for the Fed meeting. Jen, let's get to you on that. I guess I'm prompted to ask, Jen, where the suspense is, right? It looks like the market is broadly pricing in a cut. We'll get a new dot plot, right? And obviously the commentary. What are you looking for? Like, what are your sort of questions going into the meeting?
Yeah, Julie, I mean, I think 25 basis points is fully baked into the market here. The bigger question is, how many more rate cuts could we see for the rest of this year? Is it going to be one more cut, which is what we saw back in June with the dot plot, or are we going to see two more cuts? And I think that's really going to hinge on how worried are Fed officials about the labor market juxtaposed with where inflation is right now. We are seeing a trend over the summer months. Fed officials came into the summer saying, we want to see what the impact of tariffs is going to be on inflation. Little did we know we were going to see constant softening in the job market. In fact, job growth turned negative in the month of June. And at the same time, the inflation rate right now is running a full percentage point above the Fed's 2% target. And Fed Chair Powell has said, base case, this is going to be a one-time increase in prices. We could probably look through this. But he's also said it's the Fed's job to make sure that inflation doesn't turn into persistent inflation, which is what we saw after the pandemic and supply chain shocks. So while the Fed is probably going to do one more than one cut this year, I think the fact that inflation is still running a full percentage point above their target is going to keep them from perhaps cutting more than they otherwise would, given what we're seeing on the job side of their dual mandate.
And something else, Jen, we should note, speaking of suspense, is, the meeting is about to start, and we still don't know necessarily who's going to be in the room, right? Stephen Meyer, the administration's nominee, he's still waiting for confirmation. The administration's still trying to get Lisa Cook out before the meeting happens, although that's looking less and less likely. But, there's still some moving parts there.
Right. As if watching the data wasn't enough, we're also watching the players. I do expect the full Senate to confirm Stephen Meyer later today. Votes expected to start at 5:30, so he probably will get confirmation an hour or two after that, putting him in place just in time to get sworn in ahead of the Fed's FOMC meeting, which kicks off tomorrow morning, concluding on Wednesday. So he will be in place. And of course, he's replacing former Fed Governor Adriana Kugler for a term of just basically 4 months. It's going to end at the end of January. At the same time, as you mentioned, the president really trying to shape the Fed and pack it with members that are in favor of lower interest rates. And so he has fired Fed Governor Lisa Cook over claims that she claimed 2 properties that she purchased as primary residence to get more favorable loan terms. But over the weekend, there were new findings that actually revealed that a condo that she purchased back in June of 2021 was put down as a vacation home at the time. So perhaps a characterization that could undermine the president's claims. And of course, at the same time, over the weekend, we also saw Cook's lawyer file to appeal Trump's emergency appeal after a U.S. district court ruled last week that Cook could remain in place for the remainder of the time that these court proceedings are going through, and seemed to not find cause, that the president had cause, rather, to fire Cook. Of course, the administration pushing back against that. It looks like Cook will probably be in place. I mean, who knows if the court ends up ruling sometime today. If she is, I expect her to vote in line with Fed Chair Jay Powell.
Right, as she has been. Thank you so much, guys. Allie, Dan, Jennifer. We've got some breaking news, meantime, from the White House. President Trump suggesting changes to the way that publicly traded companies report earnings. The president posting on Truth Social that companies and corporations should no longer be forced to report on a quarterly basis. The president said that this would be subject to Securities and Exchange Commission approval, but any change would significantly affect the way investors and analysts gauge the health of corporate America. This, by the way, is not the first time that President Trump has suggested a change to reporting structure. Back in 2018, President Trump said he wanted securities regulators to study the idea of having public companies report earnings twice per year instead of a quarterly as a way to promote job growth. He later noted that the idea came from former Pepsi chair and CEO Indra Nooyi. Trump compared the U.S. reporting process to China, suggesting that Beijing had a system in place that was more efficient and cost-effective for businesses in that country. Coming up, we'll count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance.
Amid growing pressure from Wall Street, stubborn inflation, and a weakening job market, will the Fed finally cut? Don't miss our live coverage of the Federal Reserve interest rate decision, live from D.C., Wednesday at 2 p.m. Eastern.
Now time for some of today's trending tickers. We are watching Tesla, chip makers, and hims and hers. First up, we got Tesla. CEO Elon Musk buying $1 billion worth of Tesla shares. The billionaire bought the stock indirectly through a revocable trust last week. That's according to a regulatory filing. The outspoken CEO's last significant purchase of Tesla shares in the open market was in February of 2020. So this purchase marks Musk's largest insider acquisition ever by value, according to Verity data. Tesla shares this year have been weighed down by slumping sales, partly tied to Musk's political activities hurting the brand, along with the end of certain incentives for electric vehicles by the Trump administration. Those shares, by the way, up more than 7.5%. Next up, we got chip makers. China is launching 2 investigations targeting the U.S. semiconductor industry. The Ministry of Commerce opened an anti-dumping probe related to certain American-made analog IC chips. Those are the sort of products sold by companies like Texas Instruments and Analog Devices. At the same time, the ministry also kicked off an anti-discrimination investigation into U.S. moves against the Chinese chip sector. Meanwhile, China's market regulator said that Nvidia violated the country's anti-monopoly law, according to a preliminary probe. All of this coming as the U.S. and China meet for trade negotiations in Madrid. China's market regulator on Monday said that Nvidia violated the country's anti-monopoly law. That's according to a preliminary probe. You can see all the stocks are down, but because this is sort of newer on the analog front, TI and Analog Devices taking a bit of a bigger hit. And finally, hims and hers. The FDA said a widely watched TV commercial from the telehealth firm earlier this year breached the agency's regulations. Now, the agency said the advertisement is an example of the industry's misleading advertisements. The FDA commissioner said online pharmacies are advertising drugs with only upsides mentioned, contributing to America's culture of over-reliance on pharmaceuticals for health. The ad in question promoted the use of its compounded version of Novo Nordisk's obesity drug, Wegovy. I believe it played during the Super Bowl. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, U.S. stocks are trading at record highs as rate cut bets boost sentiment, but top Wall Street strategists say the Fed could throw cold water on the stock rally. Bullish investors began to focus on a weakening economy. Joining us now, Kevin Gordon, Charles Schwab Director and Senior Investment Strategist. Good to see you, Kevin.
Morning, Julie. Nice to see you.
So it's always so interesting when we start to get in the bad news is good news scenario in the markets. In other words, when you get a jobs report that is very disappointing, but stocks go up because the bets on Fed rate cuts. Does that sentiment kind of switch on a dime, though, at some point? How does that work?
It can. If the jobs report is corroborated by other labor evidence that there is more deterioration, things like claims, or even within the labor reports, further weakening in the household survey. I think one of the reasons that there hasn't been as extreme to the downside, as extreme of a negative reaction for the market in terms of labor itself and the jobs report we get is all of the revisions, for example, that we've gotten now, the preliminary benchmark revisions for the prior year, down more than 900,000 jobs. Most of that was sort of known and kind of told by the household survey leading up to this. So it's not as if we got this surprise out of nowhere and we didn't have any other evidence that there was probably going to be a step down in the estimate for payrolls. You know that from the monthly birth death adjustment that we get every single jobs report. So there's still enough corroborating evidence that yes, there has been a slowdown, but there hasn't been as big of a pickup in jobless claims coinciding with, or at least telling the story of this massive drop in labor demand. And I think so far that's probably what the market's keying off of, the fact that the productivity story has been better.
And the other fact that earnings are still holding up relatively well in the face of all of that.
Yeah, and I think that's been the biggest upside surprise probably for the first half of the year in terms of the results that we've gotten for earnings. And you look just quarter by quarter so far, and this has really been the case actually since the end of 2024, where you've had a really low starting point for estimates. Whether analysts don't have, because they don't have the forecasting ability because of this environment, or whether confidence is just pretty low from the get-go. But you start out really low, and then the blended earnings growth rate climbs pretty remarkably throughout the reporting quarter. So it's still been the case for 3 consecutive quarters that we've seen that kind of upside surprise. I think that's been a pretty healthy lift for the market. But also the fact that companies have been working on pretty solid inventories still that has been drawing down. So I think as you turn the page to 2026, that story probably starts to change a little bit. You're starting to hear a lot more about companies sifting through, cost mitigation strategies and how they're going to be able to deal with rising costs. So I do think that's probably going to become more of a dominant theme as you get into 2026. But at the same time, I think the split that we've seen so far this year, large versus small, with large caps just being able to weather this a lot better, I don't really expect that to change, and we don't really expect that to change.
Interesting, because there are some people who are coming in and saying once rates start to go down, the small caps maybe will gain a little bit more favor again.
I think that on the margin, yeah, I think that could help small caps. But I think from an index perspective, that's probably going to still keep small caps at a relatively inferior spot.
Right,
when you
on a relative basis.
Exactly,
right.
But it doesn't mean that small caps can't do well. And I think even when you look at it, whether it's an index like the S&P 600 or the Russell 2000, I mean, there are plenty of names and industries in those indexes that have done well this year.
Sure.
It's just that they're weighed down so much because they're larger indexes by member count. So they're weighed down a lot more by just a larger share of companies that don't have solid fundamentals.
Right, or aren't profitable, for example. There has been a little bit of talk that once the Fed starts cutting, that maybe stocks will waver a little bit, sort of a sell the news scenario. Do you think there's a risk of that?
If you go back in history and you take the current scenario, which is they've been on hold for at least 6 months and they're going to restart a cutting cycle, potentially. At least they're going to start cutting again. There have been 7 instances of that in history. So this will presumably be the 8th. Of those 7 instances, looking a year out from the re-engagement or the restarting of that cutting cycle, you've got an average gain for the S&P of about 12%, which is pretty great.
Okay, not
bad.
But
the range around that average is huge. So in the best case scenario, you were up more than 50%. In the worst case scenario, you were up about 4%. And in the worst case scenario, what I find interesting is that it was the recession of 1990. It was a short and shallow bear market. It was not a devastating recession for the broader economy. But it also goes to show that there could be instances where the Fed is cutting and responding to more weakness in the economy. Probably a stretch to say that this is a complete replay of any of those scenarios, because it never really is. But I also think you have to keep your mind open about what is possible sort of in terms of deterioration in labor and the fact that this is just a unique environment. I mean, most of the labor story today, I think, is centers around and should focus the most on the relative deterioration we've seen in labor supply, and the fact that that's probably going to keep the unemployment rate low, at least in the near term, and it's going to be, I think, the most dominant sort of driver of labor activity in the near term.
And then just quickly, you guys have really been hammering the idea of quality when it comes to strategy, buying companies that have strong balance sheets, strong earnings power. Are you sticking with that playbook?
Yeah, and the reason that we've been really hitting the table on this is because for the past several years, this has been a theme that's, the higher quality theme has been consistent in terms of performance across sectors. It's been such a difficult environment for especially individual investors to be able to sit through all of this policy uncertainty and think to yourself, what out of the 11 sectors is going to be the best or the worst? But if you take that more characteristic or fundamental or factor-based approach, that lets you sort of sift through a lot of that unease around trying to figure out what sectors are going to be best positioned or worst positioned. I mean, there will be a point, I think, where it'll come more into clarity in terms of what sectors can do well. But if you're wanting to be more defensive and go low vol, then you can find that in any sector. Vice versa, if you want to be high momentum and catch that really fast trade in terms of what's catching the most upside momentum, you can find that in any sector too.
Kevin, good to see you. Thanks for coming in. Appreciate it. That does it for Morning Brief. Coming up on Yahoo Finance, we've got the opening bell and opening bid with Brian Stasi. Stay tuned.